Welcome back to Curious Commerce, Capital Budgeting Series, Part 5. Let us start with a powerful question. How do companies actually decide the investments? Do they just guess or do they follow institutions? Practically no. Big companies never take decision randomly. They follow a thumb rule. They follow a step-by-step process because one wrong decision can lead to huge losses, sometimes end up with the bankrupt. Today we will understand the exact steps are followed by the companies before investing the money. In real businesses, every investment goes through the multiple stages. It is not like we like this project, let's invest. Instead of this, companies analyze, compare, evaluate. The reason is money is limited in nature, risk is high. So they follow a structured process to avoid the mistakes. Now understand this clearly. Capital budgeting is not random. It is a logical and systematic process. Each step has a purpose. If we skip one step, decision may go wrong. So let's understand each step one by one, from identify to review. Step 1 is identify investment opportunities. This means finding possible projects. For example, opening a new branch, buying a new machine, expanding production. Question company asks, where should we invest? Opportunity must match the business needs. Not every idea is a good idea. That's why identify the investment opportunities. Second step is estimate cash flows. Second step is very important. Estimate the cash flows. This includes initial investment. It means that cash outflow and the future returns. It means that cash inflows. For example, machine costs rupees 5 lakh. Expected return is 1 lakh per year. Now company estimates how much money will come, when will it come, and the important point is decisions are based on cash, not on profit. Because cash is real, profit can be adjusted. Step 3 is the evaluation the project. Third step is the evaluation. Now companies checks this project is good or not on the basis of the first thing, the cash inflow and the cash outflows. Then they use the method like the NPV, net present value. That is the technique of the capital budgeting. In future classes we will discuss. IRR, the internal rate of return. This is also the important technique of the capital budgeting. The simple idea, if returns is more compared to the cost, accept the project. If the return is less compared to the cost, reject the project. It is very simple thumb rule. If the return is more compared to the cost, accept the project. If the return is less compared to the cost, reject the project. For example, project gives 10 lakh rupees return, but the cost is 12 lakh rupees. Our thumb rule is if the return is more than the cost, accept the project. If the return is less than the cost, reject the project. In this case, project gives 10 lakh rupees return and the cost is 12 lakh rupees. It means that the return is less than the cost. So, on the basis of the scientific method, we reject the project. So, in each stages of taking the decision, the evaluation is very important for accept and reject the projects. Step 4 is select the best project. After the evaluation, company may have multiple options. Now question is which one is best? We have the n number of the project. Out of that, which one is best? So companies select the major criteria like the highest return and the risk level, we call it as the acceptable risk, and the feasibility of the project. For example, the project A gives the 10 lakh rupees return at the end of the year. The project gives 15 lakh rupees return at the end of the year. It is very easy compared to the project A and project B. The project B gives 15 lakh, it means that the 5 lakh rupees is more compared to the project A. Directly we select the project B, but also checks the risk and practicality, right? What about the risk factors in project A and project B? And what are the risk factors in the project B and A compared with all other projects practically? Step 5 is the implement the project. Now comes the execution stage. Selected project on the basis of the written risk. We select the project and that selected project is implemented. This includes the allocation of funds and initiation for the work and managing the operations. For example, buying machines, hiring staff, and starting production activity. The important point is good planning must be followed by the proper execution. Otherwise, even a good project can fail. Step 6 or the final step is the review and control. Companies compare the expected return and the actual return. The example is the expected profit is 1 lakh, but the actual profit is 70,000 rupees. Then the company asks, why difference? They take a corrective actions to minimize the difference between the expected and actual returns. This step helps to improve the future decisions. A quick summary. Let us quickly revise. First, we should identify the opportunity. The second step is the estimate the cash flows. Third one is the evaluate the project. The fourth one is select the best option. And the fifth one is the implement. The plan, analyze, decide, execute, and improve. This structure process ensures the success of any business or any project. In the next video, we will see the real life examples of captive budgeting. This will make concept even clear. Stay connected with the Curious Commerce to learn the real business scenarios. Follow Curious Commerce Financial Management Hub in WhatsApp channel for daily updates about the finance and the economy. Thank you all.